Okay, and with that, it's 4:02. The show is on, and I guess the very first comment was, "What's wrong with Long Island?" So let me just ask you, Greg, what's wrong with Long Island?
I didn't say what's wrong with Long Island. It's a great
How
place.
is Long Island doing now? Is Long Island doing as well as Connecticut is doing? Is the Connecticut phenomenon true in Long Island and in New Jersey, equally true in Long Island, New Jersey, and Westchester?
Well, maybe not as big a bump as Connecticut and Westchester, which have, pretty good proximity to the city, shorter commute than I have probably, and more luxury product. But, here in Nassau County, things are great from that standpoint. We are seeing home prices rise for people looking to get away from more dense areas, even if temporarily. Plus, we've been open, for a long time. Indoor dining was open months ago. So we feel closer to normal than I'm sure Manhattan does in New York City. And fortunately, we haven't seen the spike in cases here, like a lot of the region. Maybe we just got them all out of the way early. I don't know. I'll let the scientists debate that. I'll stick to economics. That's my science. But we're doing well. It does stink now that, the cold weather is here and it's going to rain for 24 more hours. But it was a great season with the beach right up until we had shark sightings on all our beaches on the South Shore. That was the extra kick in the head. Just when you thought you could have a normal something to summer, we had to have like Jaws 2 through 10 show up on our beaches.
Okay, so before we get into the hard economic questions, of which I have already shared them with you in advance, so that I am guaranteed that you are not going to deflect and go off on some tangent. We're going to stick to the economics. But before we do, I think it's a bad idea for Long Islanders to talk about shark attacks. We don't talk about coyotes out here in Connecticut. We don't talk about sharks in Long Island. It's bad for business, Greg. Bad for business.
Well, I think it was pretty well covered in the news. By the way, no one ever got attacked by a shark, and they never actually found any of them. So, there's a difference between sightings but I told my son, who's 13 and was afraid, I said, I've been going to these beaches for 50 years and I've never even heard anyone say shark for real. So I just, it was just another thing we didn't need. But no, it's been a nice recovery here to normal. But then again, my son's school got closed down earlier this week for COVID cases. And my son has to make a socially distanced confirmation next week at 1:30 on a Wednesday afternoon. So, it's kind of the little things like that remind you that we're still in much different times.
All right. So with that, shall we get right into the meat?
Sure.
Skip right past the appetizer and get right into the meat. The first question I have for you is, well, first of all, for all of you who don't know, Greg Heym is the chief economist for Terra Holdings. He is a regular contributor on CNBC and the New York Times, The Real Deal, Wall Street Journal. Who else? Who else are you a frequent guest on?
Everybody.
I'm a frequent guest on your show, so that's the most important job.
Okay, there you have it. So he is a well-respected economist in New York, and you seem to be bullish in your blog, and I have to pick. I have to ask you a lot of hard questions about why you are so enthusiastic.
Wait do you see tomorrow's post? So.
Oh, more sunshine.
Well, we did get 2 incredible bits of data this morning. GDP coming in at 33.1%, pretty remarkable. One of the things to remember about GDP is for some reason they like to report it on an annual average growth. So that basically says if we grew this fast for the next year, the economy would grow 33.1%. But to put it in a frame of reference, the size of our economy is now just 3.5% below where it was at the end of last year. Now that still would be a recessionary gap, but If I'd have told you in April that our economy now would be just 3.5% smaller, you would have said no way. Everybody would have said no way. You know, we worried about consumer spending because the stimulus ran out in July. Now remember, this is July, August, and September we're talking about. But consumer spending rose at over a 40% annual rate in the third quarter. And people say, well, how does that happen? We had a record high savings rate. And if you read that issue of The Line, we talked about that it was the savings that people had accumulated from a variety of things, mostly stimulus payments and the inability to spend money early in the virus. You couldn't really spend much money.
It's not so surprising. We're saving, we're spending, because money is cheap, right?
Well,
Consumer
no, but
confidence
even
is high, and all that money sloshing around is causing people to make spending decisions, real estate decisions.
right. Well,
The
life goes
question is
on.
what it'll do to inflation.
Well,
Right.
I've told you, Roberto, that you don't have to even think about inflation anymore because, you know, I wasted a lot of time studying these things, you know, and you think about it, go back to February, we had a 3.5% unemployment rate, right? You know, we used to have this thing called the Phillips curve, which said that at certain levels of unemployment, you can't help but have inflation. That went out the window. And think about it. When was the last time inflation was really a problem? I mean, like, I'm not talking about the supermarket and the random.
No, it hasn't been. They've been trying to spur inflation.
Right. It's been decades. And now the Fed is now using sort of an average inflation targeting, which is their way of saying if inflation does get above our target of 2%, we're not going to act right away because for some stupid reason, the Fed has two mandates. One is to, you know, control inflation and the other one is to maximize employment. Those kind of work against each other. And, you know, I don't remember this, John probably does, but, you know, Paul Volcker several decades ago caused a recession just to end inflation. So inflation should be their number one concern.
So I just got it. I just got an email and I forwarded it to you at 3:23 from the head of the bond desk at Barclays in New York. And he said the bond market is going bananas. Quote, every bond market, UST, high grade, high yield, distressed, muni, mortgage, very active. And it's a combination of factors, even with low interest rates. And he said it's the federal government refinancing, the municipal government's refinancing, and corporate is all diving in to get it while the getting's good.
Well, why not, right? When rates are at record lows, you want to borrow. And for those municipalities and the state governments,
but he says that this is going to come to an end. He says that this is a grab now because we're going to start to see pressure on inflation. You're going to see
Because many are scrambling to do it before the election.
Right.
Now, yeah, I mean, inflation is not going to surface anytime soon. That's not going to happen. So
that old adage of, you know, real estate is a great hedge to inflation, that just is not even a part of the equation anymore.
No, I think as an asset, it's good to have something that will appreciate along with inflation on top of other gains. You know, like right now, John keeps talking about how hot Connecticut is and Long Island and Westchester. Those areas are appreciating a lot more than inflation is. So, you know, I think that it's a double-edged sword because we like mortgages under 3%, right? That sounds like a great idea, but that also means you get no interest on your savings account and that whole inflation hedge. But I mean, all I have to say is after Lehman Brothers, we kept interest rates near zero, short-term rates near zero, printed trillions of dollars. Unemployment rate fell under 4% to record low amounts. Wages went up at the fastest rate in 20 years and no inflation. So Roberto, what is going to cause the inflation? Another thing I learned in school that's useless is they used to say when governments are out borrowing money, that raises demand for bonds, right? So, you know, that should drive up the price or the interest rate of bonds. But the exact opposite happened, right? We run ridiculous deficits now. It doesn't push rates higher, even though we're competing with the, you know, the state, local municipalities and corporations that want to borrow money. We still don't have to pay higher rates of interest on it.
Yeah.
So a lot of the old.
But when does that end? You're
It
the
doesn't.
economist.
I mean, when
You
is it
say it
gonna,
doesn't end.
when is it going to end? I mean, we look at, you know, the way our economy has been since the 80s. I mean, we didn't have an inflation problem in the 90s, and we haven't had it in the last 20 years. You know, I think you can never say something is gone forever, but there's also other factors here. You know, there is a switch to a service economy, you know, where we don't make a lot of things here. That's one of the reasons why wages can be slow to come back, and certain jobs can be slow to come back, because they just make people like me work harder, you know. And I think, you know, you have these structural shifts in the economy, and this may not be as notable as the Industrial Revolution, but if you think of the role technology plays in what we do and how it enhances productivity, and there was just a study I read showing that the amount of people that are going to permanently work from home next year is going to double. And it's not necessarily because of the pandemic. Corporations are looking at how productive their people are at home. You know, I save 2.5 hours a day not commuting. You know, so I think that a bunch of factors go into this issue, and we're pretty responsible with our money. We don't.
But let me ask you, just from a personal standpoint, the moment that you're safely able to go back, are you happy to go back and that's what you're going to do? Or are you going to try to find a way to stay home 2 or 3 days a week?
No, I mean, it doesn't make sense for me. I mean, I'm either all in or I'm not. I think for a variety of reasons. It's just to get on a schedule like that is where some days maybe I could sleep till 7, and then like the next day I have to be on a 6:46 train. I don't think that's going to work out too well for me. I'm old. I need a regular sleep schedule.
You're younger than me.
But I think I'm sure everybody on this call misses, you know, the face-to-face interaction with the people I see every day. Now the problem is, for a lot of us, a lot of those people aren't working right now. You know, companies have had to furlough. Real estate is no exception. I mean, we got hit as hard as anybody.
Don't you think that that's going to be a hybrid at some point going forward? I mean,
I think, but from my standpoint, what am I going to do? It'll actually cost me more money to go in occasionally than all of the time if I'm not buying a monthly ticket. And I think that when you're a boss, like I am, and a lot of you on the call I'm sure are, you have to be there for your staff. You know, and right now, again, the staff is mostly gone for a lot of us. So, you know, we can do what we need to do via FaceTime and try to be sympathetic to what people have lost too, to take away that extra cost. But I don't lose faith in the city. I've been working in the city my whole adult life, 28 years. I'm not scared. I've already had COVID. I'm not scared of it. I'm not stupid about it, but I'm not scared of it.
All right, I got some questions.
Go ahead, hit me.
Okay, I've heard a couple things. You said housing is not relatively expensive. So that's one of your reasons that.
When did I say that? When did I say that?
No, well, you said that this is not a bubble that's going to burst.
When did I say that?
Okay. Let me come back.
Okay,
You have said in the last couple days, consumer confidence rose in September, and that was one of your reasons for being bullish. After 4 straight months of growth sales of new single-family homes, okay, that's another reason you're bullish.
Right.
And yet you've talked about initial claims for unemployment falling, another reason you're bullish. And when I say that a lot of that is because of the low interest rates, which you've agreed, and the federal stimulus, which you've agreed, is why consumer spending is up, consumer confidence is up, savings is up, all of this. And when I ask you, why isn't this a bubble?
Well,
why isn't this a bubble? Why isn't this going to get popped after the election?
What does a bubble mean to most people? I mean, I've been asked this question for 25 years. Are we in a bubble? Are we in a bubble? So my question is, what do we mean by a bubble? Most people say, let's take housing, that, you know, there's some artificial stimulant that is inflating prices. You know, we saw it a decade ago with, you know, easy to get mortgages, Alt-A mortgages that were being sold to Fannie and Freddie. So companies had an incentive to make a mortgage to anybody, knowing that they could just dump it to somebody else who would float bonds against it. Now, we also found out today that pending home sales are down. And that shouldn't be a surprise, at least temporarily, because prices were rising too fast. I also mentioned that in my newsletter. You know, you have such a low level of supply. Existing home sales were spending an average of just 20 days on the market. You know, we talk about month supply, and that's near 20 months right now in Manhattan of apartments. Nationally, that number had gotten as low as 3 months in some areas. So you need more inventory. We saw permits just hit a more than decade high level. Home builder confidence is at a record level. And why wouldn't it be? Because if you can build it, you can sell it. So I think part of the decline is there are fewer homes for sale than we need. And that needs to shift. I mean, residential building construction was up at an annualized pace of over 50% in the third quarter. So clearly there's this game of catch up that gets played. You know, every time you have a recession, builders take a break. And then when you start to recover, there's not enough product to go around. And
I have a difficulty in the fact that we're citing a lot of national statistics, national home building stats, national consumer confidence, and yet
well, we don't
we're
get
talking
these
about
stats.
20 months of inventory in New York City. And as goes New York City, so goes the bedroom communities of New Jersey, Connecticut, and Long Island.
Well, let's talk
about
it.
Time
Yeah.
understanding. And so you said you didn't say bubble. Okay. But what you did say was that it's justified, right? That you didn't say the Connecticut market is overheated. You didn't say the New York market. You said this is fine and can continue. It's
well,
not
I don't know if I didn't say fine and can continue. I didn't say that. But
okay.
I would say that when a market is behaving rationally or how you would expect it to behave, you know, for a couple of months, people couldn't go out and buy houses. Now we know that right before this happened, we had record low unemployment rates, a record stock market, wages growing at their fastest rate in 20 years. People had money. The stock market has come back enough where this isn't the wake of Lehman Brothers, where everybody's lost 40% of their investments. People should be somewhere near where they were before, unless they, you know, dramatically made some changes. With that said, the demand for housing was there. You forget that before this happened, we had an inventory problem nationally. We didn't have that problem in Manhattan and some other parts of the areas that we deal with in the tri-state area. But overall, we had a shortage of houses. That has been exacerbated now because you couldn't really build them during COVID. It's an adjustment that will take place. The prices will come down, the buyers will come back because they need housing. We haven't built enough to support the demand going forward. The difference in Manhattan is that we built too much product with not enough demand for it. You know, it became a no-brainer if you were building a condo to build full floor units and charge $3,000 a square foot or more for them. And they sold like hotcakes until things started to change about 3.5 years ago. All of a sudden, the buyers started to withdraw from the market, saying the prices were too high. And you had a glut of like new construction that was so much cheaper. People that bought apartments, you see now some of the big developments like 157, people are selling their apartments at losses. You know,
huge policy changes though too that had a big effect.
Yeah, I mean, look, it's an adjustment that takes place. If we could sell as many $1 to $3 million new apartments as we could make right now, I think the demand, even in this post-COVID world, there's a demand there. But I do think the luxury on that stuff's going to start to get absorbed because more and more people are out looking and buying now. You know, September was the first month.
How do you, okay, I got to pin you down on when. It's not fair to say, oh, we're going to absorb all the inventory. When? Dr. Fauci said yesterday that we can expect social distancing and masks, even with a vaccine, all the way through 2022. If you're in a highly dense neighborhood like New York City, that's hospitality, entertainment, airline travel has been decimated by those policies, right or wrong, and those policies will continue for another year. how do you say it's going to come back? Is it going to come back after those policies are relaxed?
Well, I'll say this, New York City has a history of people showing vision and faith in the city and benefiting from it. You know, people that came here in the 70s and the 80s, people that bought downtown when no one would live there, people that bought uptown, people that bought in parts of Brooklyn, I mean, Greenpoint, Williamsburg, people that bought Long Island City before the amenities were there, before the restaurants were there. You know, I think that we have a history of that. Now, I don't put a lot of faith, I'm just the skeptic in me, in people that say things like that, like, you know, what Dr. Fauci is saying right now. I don't think they know what they're saying in certain circumstances, to be honest. The only thing we can all agree on is this is a terrible problem that, at least for now, is getting worse. The numbers in New York,
We have to sort through those issues before New York bounces back.
no, because you know, we're not going to turn and get back to where we were. But in September, there were over 20% more contracts signed to buy an apartment in New York City, in Manhattan, than a year ago. So
all under $1.5 million, by the way, right?
no, they're not all
1% of the
under
market.
$1 million. No, you're wrong, John. They're
Okay,
not
tell me.
all under $1.5 million.
Tell me.
We had over a $40 million co-op sale happen during the lockdown. So it's, people are seeing value and they're jumping on it. Is it the stuff flying off the shelves? Of course not. We know that that's not it, but you got to crawl before you can walk. You know, you guys have had the benefit of people coming to you, looking to get out of the areas, but you know, New York City is having a problem in certain neighborhoods. But New York State as a whole, if you look at the infection rates, they're near the bottom right now. And, you know, we can talk about why that is. I think, you know, a lot of it is the number of cases we had in the beginning. But, you know, things are coming back. People know that you need to buy now to get the best deal.
New Yorkers tend to plan ahead and they tend to
Exactly.
be prepared. So when Dr. Fauci talks about, you know, through 2022, I think that New York is not going to come back in 2022. It's going to be hitting its stride in 2022. Like, it's going to be already in the works.
Right. And you know, we talked about this the last time I was on. We heard this so many times over the last 50 years that New York was done. No one was going to come back. And the quickness, I mean, Lehman Brothers was 6 months of torture and then a red hot market. It just kept going and going and going. 9/11 did not kill downtown's real estate. Sandy did not kill, you know, the Far East Side properties and everything. No one's going to buy downtown. They're going to be a flood. It's nonsense.
It's the same thing. So it's
Right.
the same thing. Every downturn, it turns and it turns fast, and then you're chasing it.
And then we're all told, this is the time, you won't come back from this. And I would say the biggest concern I have for the future of New York City is not the virus. It's the immediate concern for sure. But the long-term concern I have is what City Hall and Albany do to make this situation worse. You know, they have budget gaps for good reason, for sure. The MTA needs a bailout, NYC needs a bailout. I get that. But if they continue to think that they can just keep taxing the wealthy and real estate and just keep pushing and pushing it at a time when people are leaving, you know, that's just foolish and inept leadership. We have a very unpopular mayor. You know, it's the one, people say don't talk about politics. The one safe thing to do is to criticize de Blasio. It seems that there aren't too many people willing to defend him, to be honest with you.
You brought up the MTA deficit as an example. That's a $13 billion deficit hanging over our heads right now. What does the election and the and the way we handle the $13 billion deficit, how does that affect the New York economy? Is it actually a rather small piece of, is it a small factor overhanging the real estate market, or is it a major factor how they deal with those deficits?
I think it's a major factor for a variety of reasons. One, the MTA before this happened needed, you know, a lot of repair work. There are a lot of lines that are very old, a lot of signals that are very old. You know, I take the Long Island Railroad. That sucks most of the time, to use an economics term. You know, they needed improvements before this. And one of the concerns that you do have, you know, the latest numbers that I saw that are about a month old is that only 15% of office workers in Manhattan have returned to their desks. I'm happy to say that real estate has the highest return rate because obviously you have to be here to show it. But I think you need a transportation system, and it's got to be enough to entice people to go back to work. There's a concern that people like me, as Roberto mentioned, that have been working remotely may say, why do I need to come back? And if they have to ride, old subways or subways that aren't safe and trains that don't run on time because they don't have the money to fix them or they don't have the staff to keep them, running, that's a real problem. The subways, we always talk about how the safeness of New York City really saved us in the 90s and the work that Giuliani started. The one thing that we kept complaining about, even right up to the pandemic, was how bad the subways were. I mean, they are old, they are dirty, they are crowded. They're not built for the amount of people that ride them now, which is a problem considering that this pandemic may be with us, for another year or so, which I'm sure we all petrified at that. And also, you need the subway system to get around in New York City. So it's vital to the economy, or people won't go to certain neighborhoods, because most people in Manhattan are not driving around where they're going. And I think it's a problem because their revenues are next to nothing. Now they're getting better, but for months, nobody was riding public transportation. They were scared to death of it. So I think that what a lot of people in New York are counting on, and this is a whole different argument, is if Joe Biden wins and they flip the Senate, that New York City and the MTA will get the money that they need. The SALT cap will go away. And, that will provide a major shot in the arm to these markets.
If the SALT goes away, what do you predict on timing? And do you predict that to be an immediate net effect that something starts churning?
Well, the only problem is that's great. And I think if nothing else happened, it would be a huge boost to us, at least temporarily. The problem is that if at the same time, New York State, pushes more millionaires taxes and raises, just because you can deduct your state and local taxes, it doesn't mean you're not paying taxes. You don't get them all back. I think that's lost in some people, when they think about this. It might give New York State more of an ability to raise taxes. If I said, Roberto, you can deduct them, like, that's good. There's no $10,000 cap. I think obviously the Democrats want to do it. They put it in the stimulus that they were pushing. So I think it's something that, and it benefits their states, New York, New Jersey, Connecticut, California, clearly benefit from that. So I would say, I'm not going to give odds on what the of Biden winning and them flipping the Senate are. But if those two things both need to happen, if they don't both happen, then SALT is going to stick around.
Yes.
And a certain percentage of New York is betting on, let's say half of New York is betting on a Biden win, and that a lot of these issues are going to go away. It seems to me that's why there's been a reluctance in lowering the prices. That there's a lot of New Yorkers answering the way you're answering, which is we're getting through this. There's cheap money, tremendous confidence, a vaccine and a Biden presidency, and we'll be through this in a matter of months, right? That's where some of this optimism is coming from.
Well, also, as I write my newsletter, and again, read it tomorrow, and you want to do another one of these and yell at me more, there's things to be optimistic about. Now, New York City's recovery is lagging in a big way. Our unemployment rate is almost double the national rate, but we were the hardest hit place, and we are being held to the strictest reopening rules, that I've heard of. Maybe California has, some similar ones, but it's very tough when you're still down about 650,000 jobs than you were before the virus, to get that back. Now, Wall Street is having a good year now. That is turned around, which is certainly good news. And it's not all areas, just like not all real estate markets behave the same. Not all areas behave the same. But I think that if New York continues this momentum, again, people want to get a great deal. There's a lot of people that have been looking to buy or trade up. It's never been better to trade up than right now in Manhattan, because the biggest price declines are in the more expensive apartments, because that's where the oversupply is. But, you know, look at how bad our rental market is. That tells you more about the economy, because people are not getting, you know, new jobs. There isn't that new wave of college graduates, you know, that went in the spring and got their first job and first apartment. And to go back to the borrowing aspect, I don't think that's going to be the big savior. I know someone just said something about it in the chat box. Borrowing, you know, you got to pay for that someday. And it's not like we're all going to go into default. You know, the federal government can say, all right, I think the problem is there's legitimate concern that some of these municipalities aren't trying to cut their spending. And, you know, you don't want to let infrastructure fall apart. But, you know, at some point you have to cut spending. And one of the things I've been talking about going back to Lehman Brothers is, you know, New York City pays very generous benefits to certain types of workers. And I'm not going to argue that cops and firefighters and teachers don't deserve to be paid well, but you got to look at what you can afford. Most companies don't give pensions anymore because they can't afford them. And I think that, you know, government has tried to move away from that model, but it leads to you when you look at what percentage of the city's budget goes to pay for fringe benefits and payroll and for pensions, it's an unbelievable percentage. And that's, you know, and the debt that they have is only going to keep rising. Now, you know, de Blasio is looking for more borrowing authority and Cuomo doesn't want to give it to him. So there's also that disconnect at the same time. Yes, John, you don't have to raise your hand. It's your show.
There's two ways to pay for it. We borrow more. We're already seeing that. The other is taxes. There's an excellent question in the chat box, but I'll try and summarize it. That says that there's been also a tendency beyond just borrowing to tax the rich. There's a tendency to want to tax the rich. It comes in several forms. Pied-à-terre tax, which is focused on, I guess, the foreign money coming in.
Well, wait, that's not really true, though. I'm glad you brought that up, because I'll try to be brief on this, but this is something that really upsets me. You know, the notion is that New York City is saying there's all these terrible people that have the nerve to spend tens of millions of dollars on apartments, spend billions of dollars while they're here, pay more property taxes than anybody because they don't get the co-op condo abatement, which primary residents get. And, you know, and they have the nerve to only be here a couple months of the year. Let's tax them, because that's our way of saying thank you for you know, all you contribute to New York City. So their intent is to take money out of Russian and Chinese oligarchs' pockets. But as Roberto can tell you, and most brokers, those buyers aren't buying anymore. China doesn't let people come here and spend that kind of money anymore. Russians aren't buying $80 million apartments like they were a decade ago. That's not true. And, you know, the biggest pied-à-terre owners that I know in New York City are Ken Griffin and Jeff Bezos. Last time I checked, they're Americans. And this is a tax on second homes. So, John, if you had a pad in
wealthy people, it's a tax on the wealthy.
No, but the problem is the wealthy are the ones least hurt by it, because the wealthy can make one of two choices. They can just pay the tax and shut up, right? Or they can move or sell. They can sell their apartment. It's not their primary residence. They don't need to be there. Who really gets hurt by this are the jobs they support. And if you're going to put this annual tax on second homes, the luxury developers, and look, $5 million is your typical condo new development price these days. You're going to see less development, which is going to mean less construction jobs. That's also going to mean less building service workers jobs. So 32BJ jobs go away. You're going to lose retail jobs because they're not going to shop. The money they spend in restaurants, all the industries that they support. This
So what I hear you saying, though, is New York and Connecticut, a strategy to tax the rich is driving the rich out of New York, out of Connecticut, and you don't see this reversing in the short term.
Well, even if they didn't need money, the progressive movement, particularly in New York City, which is in charge in City Hall and Albany firmly in charge, wants to tax the rich. I mean, in New York City, going after
They're not on the
homeowners,
ballot, by the way, next week.
what was that? They're not on the ballot. The mayor's on the
Not on the
ballot next year.
That's going to continue 2
No,
weeks.
there's some on the ballot. Some state senators are up, I believe. But I do think, you know, they're going to push the tax the rich because that's part of their agenda. It's not going to go away after the virus does, because that's how you buy votes, especially in New York City, where 70% of the people that live are renters. It's very convenient to tax homeowners and in particular, owners of second homes who you think can't vote you out. But then when you have to explain to the construction workers and the building service workers and the retail workers why they're losing their jobs for a tax that isn't going to raise a lot of money and is going to cost you more because of all the tax revenue you're going to lose from the buildings that don't get built. It's when we speak to these assembly members, they don't get this. They just think everybody's going to pay it. But you know what? And Roberto can speak to this as well. If all of a sudden, you, John, if all of a sudden I say you have this annual tax that is associated to this apartment, the first thing you're going to do is you're going to capitalize that tax and see what it does to the value of the apartment. And then you're going to demand that much of a discount when you buy it. So this hurts everybody's values. And that's why it's a stupid idea. You want a millionaire's tax that will raise you billions of dollars. The pied-à-terre tax won't even raise $100 million. That's a rounding error in their budget.
So Roberto's having a sidebar conversation in the chat room with somebody who says, are you a buyer or a seller? Roberto says he's a buyer. Even though we have all this taxation, which isn't going away, and all this borrowing, which isn't going away, Roberto's a buyer. You're a buyer.
But it's all about time horizon, right? I'm long New York. I'm not going anywhere. And if someone wants to invest in New York and you're here for the long term, you will win. You will win, especially right now. In the 22 years I've been doing this, there's never, not once ever been a better environment where so many metrics are in your favor. Never, ever.
Right. And if
It's
you
an
believe
amazing
tax,
You're talking to a guy who left New York City in 1980. I lived through the Abe Beame administration, graffiti on the subways, crumbling infrastructure.
You'll be
high
back.
taxes, son of Sam. So, you know what? Not all of us are so patient. You're talking about what, 10 years? Is it going to take 10 years?
no. When has it taken 10 years for an isolated incident?
I'm genuinely curious. How long is it going to take for New York to solve its infrastructure problem in a way that doesn't tax the rich and rely on heavily borrowing and refinancing? Because right now, Connecticut and New York are both relying on cheap interest rates and stimulus and refinancing our debt.
Well, you're also relying on people fleeing New York City to go to you. But I think that for these people, look,
that's not a good long-term plan.
The plight of the 70s and 80s didn't happen quickly like the coronavirus did. That was mismanagement by Abe Beame and John Lindsay and Ed Koch, you know, and David Dinkins, literally letting infrastructure crumble, over hiring city workers to a ridiculous level, and then being soft on crime. And you see how quickly that turned around when Rudy Giuliani became mayor, you know, with some simple concepts. We're going to arrest people that commit crimes. We're going to repurpose areas like Lower Manhattan that are dead commercially and make them vibrant residential markets, which they did. We're going to, you know, diversify our economy because we can't rely on Wall Street to give us money every year. That was the vision that Giuliani had that was so positive for New York City. And I think that's, you know, that was solving a decade-long problem. I think in this case, it's a temporary thing that will go away. People have that vision and they will move forward. And look, we're not going to get you back. All right, you know, I'll get over that, John, because I'll still see you, I guess, occasionally. But you know, it wasn't that long ago, John, where we had this exodus in the 80s and everybody went to the suburbs for the better schools.
And they're coming back now, and they're doing it again now.
Right, until they look and they see that their property taxes are insane, even if they're deductible. And the other thing is, you know,
Wait, the property taxes in Connecticut are insane?
Of course they are. I live in Long Island. They're insane here in Westchester. All these places people are flocking to. People realized a couple of decades ago that they were better off staying in Manhattan and paying for private schools than moving to Connecticut. And because one of the things that you're forgetting is everybody that lives in Manhattan saw a reason or a number of reasons why they wanted to be here. And that has not changed. The fact that the theaters are closed and all this stuff is happening is temporary. Though a lot of these people that are leaving for, more suburban areas are going to realize they don't have what they wanted, that it sounded like a good idea. Decisions made, I heard this years ago at a graduation,
I don't know.
decisions made out of fear are never good decisions. People that chose to live in Manhattan chose that for a reason. They wanted to be close to work. They wanted to be close to the restaurants, the theater, the museums, they wanted a mass transit system that got them around. So I think that you have to keep that in mind. People, it's like you break up with somebody and then 6 months later, you realized why you dated them, right? That it wasn't greener pastures. That's kind of how I got married. But I think that, that's something that I think you're discounting. You can smile and be all happy in your nice living room there. And that works for you.
This is a basement. We have basements in Connecticut.
Okay.
He's
Well,
very happy there, by the way. He really
yeah.
is.
Now,
Connecticut basement is a lot nicer than a lot of apartments in New York. But go on.
but that's great. What can you walk to from your basement, John?
The train that
And
gets
how
me
many
to Manhattan.
how many coyotes would you encounter with Acme products ready to kill you? You got Wiley out there. You have to be the road runner to get away from them. And I'm telling you that the people. Why do you think we have an aging population in New York City? Because more and more people realize.
I want to get back to taxes. Taxes are going
Go
to
ahead.
are really important to your market and mine.
Of course they are.
Right now, I think Connecticut, it's got some issues right now with respect to its deficits. I don't think they're as bad as New York's. And therefore, I think that if New York then Connecticut may win as New York loses. For the most part, I think for the long term, as New York succeeds, Connecticut succeeds. In the short term, I see Connecticut as 1% taxation, 20 grand property taxes on a $2 million house in Darien or Greenwich. So it's roughly 1%. Maybe it's a little bit more than that, in Stanford. Tammy can perhaps answer that, but it's roughly 1%. I don't consider that excessive taxation, considering we're providing a lot of great services right now, parks, schools, a decent commute in Connecticut. And so Connecticut's winning in the short term. Connecticut, in order to win in the long term, needs New York to fix its fiscal house.
Okay, I got the perfect answer to that. And I'm not knocking Connecticut. I'm not. I love Tammy. I love our Connecticut offices, but you're forgetting what went on the last 10 years. The one thing that you forget is it's the New York City economy that feeds your market. How many of those people you sell houses to work in New York City? And
that's why I say they move together over the long term.
Right. And the short term is going to be shorter than you think, I think, because New York City's economy is such a strong engine of growth. Unfortunately, the Fairfield County economy has not done so well in recent expansions. All of that trading space that was opened on 95 is closed, right? All those companies went back to New York. You know why? Because there's a reason they were there in the first place. That's where their employees want to be. That's where they feel they need to be, where they're around the greatest number of people. And I think that, we keep hearing for years how people and companies don't need to be here. They're going to leave here. They're not going to come back. It's a load of malarkey, to use a nice term. Facebook is expanding here. Google is expanding here. Even after giving them the shaft, Amazon is expanding here. You're forgetting that there will be new crops of these tech workers that will buy homes, and people that were renters that are in the greatest buying position in well over a decade to go in and get a phenomenal deal at record low interest rates. This isn't a contest. Like I said to you a month ago, John, it's not a contest. We can all benefit. you're forgetting the blow to New York City was
I just want to
unbelievable.
get to the specifics.
Yeah,
All
it's
the
that too, actually.
New York, if the New York economy is going to be pulled out of this by tech workers, Amazon, Facebook, and I don't doubt it. Where are they gonna live? Because New York has an affordable housing problem right now. You don't have a lot of $1 million apartments. You don't have enough inventory.
Well, right now we do. Right now we do. That'll change, but
There's also a tremendous amount of rental inventory.
right,
They rent first, then they buy. There's a certain cycle that's going to happen.
right.
And that
Exactly.
the city has tremendous resources in order to make this happen. And the moment people like Google and Facebook and all of them start coming in, the sentiment is that it's okay. And everybody's going to want to come back and be back, because that's what New Yorkers are about. They're about being here and rubbing elbows with one another. And by the time the vaccine, it's just going to grow. It always has, and it's just going to do the same.
And we know John is going to be rooting for our return because it will feed his market.
I think so.
And I think that,
No
you
doubt.
know,
I need the Yankees to play. I need Broadway to light back up. I need cruise ships to show up in the harbor. I need the airlines to, which are down, 80% through our airports. Yeah, your airports are my airports. Your Broadway is my Broadway.
Something
no, and we need the Yankees. The problem is they need starting pitching, and they need someone who doesn't strike out 200 times a year in their lineup. But I think that people want New York to do well.
Yankees and New York need to reassess what they can afford in an economy that's whose GDP is down 30% or more.
Well, I think that you see when things reopen how quickly they come back. I can tell you here in Long Island, it's been an unbelievable progression since restaurants first opened. I think it was in June, to indoor dining. It's been an unbelievable. I mean, and I've heard it from people now in Manhattan that if you don't have a reservation, you're not getting a table in most restaurants. And I know that's only 25% in Manhattan, but compare that to what people were saying a couple months ago. It's like what I say about GDP. People will say, that's great, GDP had a record third quarter, but the virus is spiking now and all this stuff is happening. And, but if I'd have told you in April that our economy would only be 3.5% smaller than it is now, you would have said, no way, you're out of your mind. This is going to be a Great Depression. We're not going to come out of this. A couple million people are going to lose their lives. I think that we've become such a negative society because of all the factors that social media and whatever you want to say. But it goes to consumer confidence. And since the consumer is, 70% of the economy, that's really important, how confident they are. But they're also very fickle. Right now, confidence took a little bit of a ding because of the election, I think is causing people, and the fact that we may not know on Tuesday who won, we probably won't know. And the cases are spiking, and we don't know what that means. But consumer confidence is like the stock market. It can change overnight. And I think that's, something that we have to keep in mind. The consumers have had enough of this. I think we've all had enough of this. We want to go out and buy things and return to normal. We want to do it in a smart way. And people want to return to New York. I talk to people every day that are in their Connecticut homes, out in the Hamptons, or up in Maine where they have second homes, and they can't stand it. It's nothing against those areas. It's a huge change from their everyday life. Just like if you got out of your basement and into a one bedroom, you'd probably feel a little claustrophobic at first. It's a change that people are making out of fear. And I think at the end, a lot of them are going to realize why they love New York in the first place, and they're going to want to come back.
John, can I say something?
John, Greg, can I say something?
Your mic
We're talking about
isn't working. Go ahead, Dinyar.
So we are talking about taxes, but we are not really saying anything about why we need to tax the rich and what's happening to all the money that's being taxed. Look at what happened to France a few years ago. They had these high taxes, the millionaires fled. I am from India. I can tell you, when they raised taxes, super tax, nobody paid the taxes anymore. It's like raising taxes is like, yeah, you can get a few people to pay up, but most of all are not going to pay. They're going to do something else.
Right.
They're going to find a way not to pay.
And that's what doesn't get modeled in. And, even in real estate, history has several examples of how people make decisions based on taxes. Here in New York, last year we had transfer and mansion taxes raised significantly. So and that started July 1st. We had the greatest June in the history of anything. It was maybe the greatest month we've ever had, followed by a terrible second half of the year into the beginning of this year. When capital gains tax rates were raised 8 years ago, everybody and their mothers sold their home at the end of December to avoid paying that increase. And I agree with you. I mean, one of the things they try to do to sell these taxes is to dedicate the revenue to something. Like the pied-à-terre tax last year was supposed to go to the MTA. Then they said this year they wanted it to go to NYC. But in the bill, it doesn't say where it's going to go other than Albany's pocket. So I agree that the millionaires tax would raise, again, over $1 billion in New York City, potentially even more. So that money should make a difference. But when your budget gaps are over $10 billion, nothing is going to help. It's got to be a combination of aid and taxes and cutting spending. But no politician wants to cut any spending. So I think we have to be very careful. Another thing, and this goes to the argument about, John, you're making about higher taxes and what that means to real estate. Joe Biden is proposing essentially doubling the capital gains tax rate to over 40%. I had this argument with my uncle, who's a wealth manager, yesterday, and I said, isn't this going to tank the market? Because everybody's going to sell right before the rates go up, to avoid paying double. And look, a lot of the stocks, if not most of them, are held in retirement accounts, but still, isn't that going to really lead to a stock market correction? And he doesn't think so. And neither does Goldman Sachs. They've come out and said it, because short-term effects usually go away over time to a degree. And there's a belief that these new capital gains rates will not deter investment, because it's still, the highest return you can get is in the stock market historically. So we can't bank on anything happening. Yes, John, you had your hand up. Did Tammy's mic get fixed?
Go ahead, Tammy.
I was going to say, as you guys are going back and forth, that it's not a zero-sum game that Connecticut's going to win and New York's going to lose, or vice versa. And I think we have to keep it in perspective. I mean, Connecticut has seen tens of thousands of people come to Connecticut over the last 2 months alone. And it's been a huge boom for us, and these people are going to pay taxes and support our economy. But it's a pinpoint. I mean, tens of thousands of people leaving Manhattan, I'm not sure you're going to notice that, really. I mean, it's when you lose 1 million people, maybe it notice, but tens of thousands of people in Manhattan,
We're losing you, Tammy.
I mean, it's great for us.
The mic isn't working so great. I do want to ask Greg, rather than debate whether New York's coming back or not, what parts of New York are going to come back fastest? And I'm going to tell you, in Connecticut, if I look at the 16 towns, 8 of them are having an increase in total dollar volume over last year of 50-70%. And a bunch of them are increasing, but only at the 2 to 15% level. Where are the areas of highest growth in New York over the next 3-4 years?
Well, I would say areas that have single family homes. Brooklyn has done much better than Manhattan in terms of coming back quicker, because Brooklyn is mostly a single family home market, and with concerns about the virus, it's kind of like the suburban effect. If I want to go look at a house in Connecticut, I can get in my car and drive there. I don't have to take the subway. I don't have to see a doorman and a lot of people. I can get in and out without coming in contact with anybody. And I think that's why Brooklyn has thrived. And other parts of Manhattan, other parts of the city like Queens that have a lot of single family homes are doing very well right now. And with rates being so low, that also helps the more affordable areas. But the best answer I could give you is the areas that are going to do well in the coming months are the areas that were doing the best before the pandemic, because those areas are hot for a reason. Upper Manhattan has done incredibly well because there's a low supply of homes for sale there, and it's relatively affordable and has good transportation. and has seen a lot of good restaurants and other amenities come to that area as development has picked up.
So
Areas that,
out of town, I just heard Brooklyn and I heard Harlem. I think that's shorthand for Harlem. Where else? Where else should I be looking?
well, I think you can look downtown because Wall Street has come back. Tech is still there. People want to live there, particularly between 34th and 14th Street, where it hasn't been overbuilt. I mean, to be honest, downtown south of 14th Street has had a massive amount of new construction over the last decade. I think the West Side is an area that has done incredibly well in this cycle and hasn't had the high inventory rates of Midtown and the Upper East Side. I think those are two areas that I'd be concerned about. Because look, if you want to get the best deal, you go where there's the most supply. But I don't know that people are going to have that vision right away to look at an area like Midtown, you know, and because of the sheer inventory from development and aggressive pricing that is built up in those two areas are going to require big price adjustments. I think for us, do well is to have activity, people looking, signing contracts and buying. We're not necessarily worried about prices rising. We know that prices are going to continue to fall till this glut of inventory is absorbed. And right now that inventory is the worst by far in Manhattan above $5 million. You know, we're looking at over a 30-month supply of those apartments. A pied-à-terre tax could potentially double that supply almost overnight. And I think that's a concern. You know, a lot of brokers say, should we list now? Should we wait for the spring? And, you know, the one thing that I feel fairly confident, and I don't think it's a big leap to make, is to absorb what we have in Manhattan is going to take past the spring, especially depending on how much stuff comes on. That doesn't mean nobody buys during that time, John. It just means that, you know, sellers have to be more realistic than they've ever had to be. And, you know, I think that that's the momentum we're starting to see now.
What I've heard is that the prices have not reflected the reality and that they've got to come down quite a bit more.
Well, it's a standoff. It's a standoff because how much do prices need to decline? We had a correction right before this happened, and we had a great start to 2020. We saw contract.
Put a number on it. I think they've come down 15%, and I think they need to come down another 15 to hit.
Well, you're just making up that number. There's no number you can slap on an entire market, and I think it's. I always tell my brokers it's irresponsible to do so. But
everything here is a micro market. Is it a pied-à-terre here? Is it a townhouse there? Is it that neighborhood? This block? It's very, very segmented.
Look, you're seeing bidding wars in Brooklyn. You're seeing, you know, you're seeing bidding wars in Manhattan in certain areas. You know, it takes time. It took 6 months after Lehman Brothers to figure out where prices really needed to be. And that's when things started moving again. And for us, we're in that phase now. It's a dance that buyers and sellers play until it gets here. And if you get into that right zone, you sell pretty quickly these days.
The market here is quite efficient. The market
Yes.
has always been quite efficient. And the fact is that, what did we talk about? It's something like 25% of the COVID deals have actually closed. Once 100, like we get more towards 100% of those deals in the next couple of months, sellers can't deny where the pricing level is going to be. So that's
Right.
going to define your
And
market.
that's why, you know, the tool we use here, John, that I get good feedback on is I send our brokers a list of deals negotiated after the lockdowns, March 22nd, that have closed. So we know what the prices were, what the discounts were. And that's showing an average price that is about 11% lower than the same period a year ago.
Okay, so I said 15, you're saying 11.
Well, I'm not saying that. I'm just saying the average. The average price does not mean how much every apartment's appreciated or depreciated. But we know we're chasing a moving target. We know that prices are going to go lower, as that's the only way activity is going to pick up to a level where, you know, we feel we know where things are. You want to cut your price first rather than last. You know, I think that makes a lot of sense. If you're a seller and you're serious and you're willing to price accordingly, now would be the time. It doesn't seem like the most opportune moment, but I don't see how things price-wise are going to turn around in the next couple of months. I don't see things leveling off, and nobody sees prices rising come spring when more product hits the market. You know, we're still licking our wounds, but I think, you know, yeah, and to go to what Roberto said, the efficiency can be here because in a good quarter, we have between 2,000 and 3,000 sales. In your areas, Darien might have 30, 40 sales in a quarter, you know, parts of Greenwich less than that because they're smaller markets. We can be a little more efficient here.
Darien and New Canaan sell 250 houses per year each.
Right, that's what I'm saying. So you're seeing much smaller amounts of data. We when we have a fully functioning market, have a lot more transactions to look at, although closing data always lags.
I love Charlie's question in the chat. It says, should we all buy well-located midtown office buildings and convert them to affordable rental residential space?
Well, you know, there's been a rezoning of Midtown to allow companies to make their office buildings bigger. JP Morgan Chase is doing this, probably not too happy that they're doing it now. You know, New York City has an affordable housing problem. It has for
They're going to
decades.
fix it with zoning?
Zoning may be the only method to fix it because there is, you know, 421A was a program started in the 70s to encourage new construction of housing. Somewhere along the line, the politicians turned it into a luxury housing proposal and killed it and replaced it with an affordable housing credit to build affordable rental units. Now they want to take that away, allegedly. And I you know, you need to encourage the building of all housing because that's ultimately what will bring prices down. And unfortunately, rent control.
You hear that, Dinyar? Dinyar is a fabulous builder. Dinyar, you got to build affordable housing. You got to stop building all this fancy housing.
Just build housing. Build. You know, you sent me this article about rent regulations, John, and what it does to development. And, you know, that really hurts so many of these new renters coming into New York City that 1 million of these units are taken. They're never going to get them. And it drives up the market rents of the other units. And, you know, economists don't like price controls on anything unless they're communists. You need to let a free market work to a certain degree. The problem is where it makes the most sense to build affordable housing is where land is cheaper. But, you know, we don't want to put it all in one area. That's not fair and that doesn't make sense. So I think one of the reasons these politicians like the pied-à-terre tax is they foolishly think it's going to make New York more affordable for people. So if a $5 million apartment becomes a $4 million apartment, someone can suddenly buy it that couldn't get it before. I think, you know, zoning is a way to do that. The problem is New York has been on a landmarking binge for years, you know, trying to preserve people's views and neighborhoods, and community boards have as much say, it seems, in what goes on as the politicians do, you know, the whole NIMBY effect. And I think that certainly hurts development.
Greg, you got just a warning. You got a lot of preservationists on this call. Dinyar loves rehabbing old landmark buildings, loves rehabbing.
And
I see all kinds of people here on the screen now who love.
But you can't have it both ways. You can't have all these provisions that are anti-development and then want to build more affordable housing. Something at some point has to give. And I think, you know, the city needs to take a look at zoning and see what it can do. I mean, again, look at what was done in Lower Manhattan in the 90s. When you rezone districts to allow for residential, the area exploded. It used to be at 5 o'clock near Wall Street, the lights were out and nobody was there unless they were in a bar or restaurant. Now it's been the fastest growing neighborhood for 2 decades in New York. And I think, you know, they have to I was on a call 2 weeks ago with the planning commissioner for New York City, and she was echoing that, like they need to look at these areas and see what they can do, because the city doesn't have money to give tax benefits right now for development. I mean, that's certainly clear with the deficits they're running. So that leaves zoning, and I'm not a zoning expert, so I'll stay out of it. But another thing, by the way, that New York City is trying to do, which could be hurtful to certain areas of the market, is to reform property taxes, which are inequitable in New York City. Tax equity is a big problem in New York, as it is in many areas. In Long Island, we just had massive reassessments to to make the taxes more equitable. But if some of the proposed changes go through, it would be very painful for certain housing product in New York, most notably brownstones, you know, in Manhattan and Brooklyn, and pre-war co-ops would pay significantly more in taxes. So, you know, the city can change things through those two ways, you know, taxes and zoning. And let's hope that they can find a way to encourage more affordable housing, because that was the thing we heard about killing the Amazon deal. Why are we giving tax benefits to Amazon? We should, you know, build more affordable housing. Or when they killed,
politics getting in the way of a good idea?
yeah, look at the Jets stadium. Now, I'm a Jets fan for years, unfortunately, and they're terrible and they don't deserve anything. But
Another politics getting in the way of a good idea, right?
right, I mean, we could have had the Olympics. It would have led to a massive development, but because the three men in a room, and the fact that two of those men came from upstate New York, and the other one, who's in jail, came from lower Manhattan, and if it wasn't built in his district, he didn't care, killed the stadium. And look, stadiums never generate the tax revenue.
Even a stadium
promised.
isn't going to help the Jets.
No.
We're dangerously short on time.
Okay.
I want to ask, what did you learn in the hour? And I'm going to ask Roberto, what did he learn? And that would be a nice way to sum it up. What did we learn? I learned that despite all of these major structural problems in New York, that you are bullish and that you have a good reason to be bullish. I am more skeptical than you are that New York can, quote unquote, bounce back like it did from the financial crisis. I look at it as more of a long, slow process, like we saw in the 80s to 90s, because we haven't solved a lot of these issues. I think they're going to take, 10 years or more. I mean, it's one thing to turn the lights back on Broadway and allow Yankee Stadium to fill up, but we have the wrong kind of housing, and it's going to take, in a lot of places, and too little diversity of housing choice. And I think it's going to take a long time to solve that. So I think we both think New York is going to bounce back. I just think it's going to take a heck of a lot longer.
Well, I've learned that I need to spend time re-educating John on a couple of things. We have a very diverse housing stock in New York. We have 5 boroughs, John. I know maybe you haven't heard of them all, but that's like me thinking Greenwich and Darien are all of Connecticut. You need to get to the outer boroughs more. Roberto will show you around when you're in town, or we'll take you to our Brooklyn and Queens offices. I saw Jacques was on the call. Yeah, he's still on the call. Jacques will take you out wherever you want to go. I think that's the mistake people make, lumping New York City into Manhattan luxury housing. And you're talking about less than 1% of the city. I do think, as I said before, that the biggest problem I face is, I agree with you, inept leadership in the 70s and 80s and early 90s ruined New York City. It did.
Even today.
And and that's what I say, we seem headed in that direction. We're going to get a new mayor next year. But, in looking at the candidates that are ahead, I don't see a lot changing. If a progressive, party is still in charge, and they're still in charge in Albany. And I think that's where the real danger lies. We will recover from COVID, and we will change. We always, a lot of good innovation comes out of problems like this Zoom meeting we're having right now. But New York will never stop being a destination for people, but there is only so far you can push people before they say enough is enough. And we've seen that even before the SALT cap was instituted. So we're going to start our education sessions, John, you and me. We're going to go over some things. And I agree with Tammy, and I said it before, this is not a Connecticut versus New York thing, or New York versus the burbs. We all rely on the same engine, and that's New York City's economy. Nassau County, where I live, relies on it too. So does Westchester. And we all need to be rooting for a comeback here. I'm not hoping that all your recent buyers turn around and come back. Ideally, we want the people to the left to be replaced by new New York City residents.
Yes.
And I think we have a growing population, and I think people are going to see value like they did a decade ago, and we're going to be okay. But I'll let Roberto be the ultimate
I,
optimist.
I think regionally, it's a synchronous thing. We're all going to help each other out for sure. I think that the population of New York is only going to be getting stronger. The reason why it wasn't larger before is because people couldn't afford to be here. But now prices are coming down, and some people have definitely left and are not going to come back. But there's a whole bunch of people who still want to come, and now it's becoming more affordable. The best deal in town is really Manhattan. When was Manhattan in a place where you could actually come and participate in this great place like this? Also, I don't think it's going to snap back like a rubber band, but I do think it's going to be a moderate fixing of all the different systems, and it's going to come back. I don't think it's like the 70s. I think there's more mechanisms in place politically, economically, in order for things to move at a faster pace. Also, everything that's happened in the marketplace that has come back, it's been purely domestically driven. What happens when in a year and a half, when the foreigners start coming through and travel is okay? We're going to have a lot, depending upon, of course, what the dollar trade is going to be and some other different factors. But we have seen there have been no foreigners here for 6 months. That's going to change. And people are going to be coming through New York. It's going to help the hotel industry. It's going to help the service industry. It's going to help everything. And it's going to be a train that's just going to the momentum is going to be slow, but there's going to be an inertia and it's going to go.
So I have to say one thing in closing. We live in the best part of the best country in the whole world. If this doesn't make the whole thing pop, nothing will. So I talked to a lot of my Indian friends, and they're getting ready to buy in Manhattan. They want to live in Manhattan. They want to buy in Manhattan. And I'm saying, no, come to Connecticut. And they say, that's for the birds, you know.
No, you're supposed to say buy both places.
Well,
That's what
that's
you're
what I
supposed to
just said. We live in the best part of the best country in the whole world. That means Manhattan and Connecticut, New York and Connecticut. So
And
yeah,
Long Island. Don't forget Long Island. You know.
Long Island too, yes. So,
Amen to that. You
so
know, and
this whole area is going to come back strong in a few months. COVID is like, I think, overly touted. That's my opinion. I'm not a doctor, but I think that Americans in general are very concerned about this COVID thing. I'm less concerned. I go to Florida once every 2 weeks. I get myself tested. I'm fine. And if I do get COVID, I'm 80 years old. I kick the bucket. I've had a good life.
well, my parents both had it, and they're in their 80s with
Yeah.
serious health conditions. So
Yeah. So
I think we have to be optimistic and smart at the same time.
I'm
And
smart
I
at
I echo your sentiments. We as Americans, we were formed as a country who didn't like to be told what to do and what we can and can't do. Even though the British were actually not that bad to us. But and as New Yorkers and people in this region, we have an even more propensity to want to stick the middle finger out to the naysayers and prove them wrong. It's just in our DNA.
Right. So if you excuse me, I need to go for another meeting. John,
We all
thank you
need to
for
go.
having me.
Thank you for closing on such a nice sentiment. The best spot in the best nation in the world.
Yes.
Couldn't agree more. Thank you, Dinyar. Thank you, Greg. Thank you, Roberto.
I sincerely
Participating.
I sincerely believe that. I love this part of the country. I love this country, and we're all going to make it successful together. Okay, and here's my partner. We need to go. Take care, guys.
Okay.
Bye,
Bye, John.
everybody.